59 billion. That's what the United States spent on August 1st propping up a currency that isn't even its own, the Japanese yen. Officially, here's why the Trump called it the signal of friendship, and his Treasury Secretary called it fixing the disorderly yen movements. Two governments, two press briefings, two polite explanations. Neither one is the real reason. And if you think this is a story between Tokyo and Washington that has nothing to do with you, stay with me till the end. The real reason involves a number most people have never heard attached to Japan. A currency trade that has been quietly running for years. And a chain reaction that's already rattled global markets once can actually do it again. In the next few minutes, we will actually talk about why the yen actually crashed, what America did on August 1st, and why it did in such an unusual way. Why every single thing Japan tried before this failed to hold, and what happens next, which depends on one decision the Fed hasn't made yet. See, in short, what happened is that the yen crashed because of a widening rate gap, a costlier energy bill, and an overheating economy nobody was pricing in. But America actually intervened through an unusual euro selling route, specifically to avoid Japan dumping US Treasuries. Every one of Japan's 4 earlier attempts to fix this on its own actually failed within months, because none of them touched the actual rate cap. And unfortunately, where it goes next depends almost entirely on what the Fed does next with rates, not what Japan does next. Now, let me actually show you how each of those pieces fit together. By the way, I'm Nikhil. I'm a chartered accountant by profession with nearly 2 decades of experience with EY, PwC, and one of India's top wealth management firm before launching my own startup. And this is FinNiki, where I simplify money the same way I practice it. Now let's start with one idea, the carry trade. Borrow money cheap, invest it where it actually pays more. Say for example, borrow 100 rupees at 1% interest, invest it at 5%. Pay 1% interest, earn 5%, keep the 4 as difference. Now picture the same thing, a trader on London desk doing that 1,000 times over. She borrows yen for next to nothing, converts it into dollars by lunch, and parks it in an US bond paying several points more. She's not doing anything exotic. She's doing exactly what you would do with nearly free money, and so is other desk running the same strategy all at once, all selling yen to do it. Scale that to billions repeated daily and you get a currency in slow grinding decline. Call it the yen bridge. Cheap Japanese money quietly funding American returns for years without most people noticing it existed. Nothing broke, nothing altered anyone, it just kept running until it didn't. This rate gap explains most of the fall, but not all of it. In late July 2026, the yen hit nearly 163.73 against the dollar, the weakest in nearly 40 years. Almost 40% less yen per dollar than you would actually got it in few years back. 3 things that piled on top of the rate gap: a costlier energy bill tied to Iran conflict pressure on oil, Prime Minister's deficit spending plans, and the part most coverage skips: BCA Research's argument that Japan's economy might actually be overheating, not weakening. Their evidence: the real policy rate is deeply negative, wages have grown over 5% for 3 straight years, and credit growth sits at nearly 30 years high. Now, how America intervened tells you almost as much as the intervention itself. On August 1st, the New York Fed didn't sell dollars and buy yen directly. It sold euros through Goldman Sachs and Morgan Stanley to push the yen higher. Why euros? Because the US wanted to strengthen the yen without creating impression that the Japan was being forced to sell US treasuries. There's a second odd detail. Reports suggest that the treasury gave some major banks advance notice through the New York Fed. That's unusual. Intervention normally works best as surprise. Forewarned traders just position ahead of it. Remember those 2 quotes from the top: friendship and disorderly movements. An unusual currency route, apparently advance notice, and a public story that stayed carefully diplomatic the whole way through. That's not panic, that's planning built around avoiding one specific scenario: Japan forced to sell treasuries to defend its own currency. Now there are 2 things left that actually matters for your own money here: why Japan's 4 earlier attempts actually failed, and where will this actually realistically land by the end of the year. If this is helping you make sense of what's happening here, hit the like button and subscribe, and also the hype button next to it. It genuinely tells me you like more of this content. Now, back to the point that we were discussing. See, Japan isn't America's ally. In real sense, it's America's landlord. It's the largest foreign holder of US Treasuries, plus a huge chunk of US equities and corporate bonds on top. Add it up, and Japan is sitting on close to 3 trillion of American assets. The exact breakdown is on the screen. Close to 3 trillion, that's the number we teased at the beginning. If yen kept collapsing and Japan had no choice but to sell those US Treasuries for cash, the selling pushes bond prices down. When bond prices fall, yield rises. Higher yield means pricier mortgages and pricier business loan back in America. And this is happening while US debt itself keeps growing by hundreds of millions of dollars every hour, with an annual interest bill past $1 trillion. This was never really about Japan's currency, it was about who's holding America's debt and what happens if they're forced to sell it. Okay, now let's stop for a second because there's a second fear sitting underneath the debt story, and it's arguably the bigger one. It's not about who owns America's bonds, it's about what happens the moment the yen bridge starts collapsing in the other direction. The bridge we spoke about only holds up while the yen stays weak and stable. The moment it strengthens, every investor standing on it has to move fast, buy back yen to repay the loan, which means selling every other assets fast, stocks, bonds, anything to raise the cash. Thousands of investors doing that at once turns a currency move into a global sell-off. Nothing theoretical, it actually happened in August 2024. The yen suddenly strengthened and wiped out entire year's gain in 5 tradings. The Nikkei fell 12% in a single session. The shock spread into European markets too. A slow, predictable currency move is manageable. A sudden reversal is a chaos. The longer the yen kept falling through 2026, the bigger that reversal risk became. One more layer. A collapsing yen pressures other Asian currencies that compete closely with it. The Korean won, the Taiwanese dollar, the Thai baht, and so on and so forth. Close American allies, important economies, Washington didn't want instability spread across the region either. So the 159 billion move was trying to do 4 things at once: support the yen, protect the treasury market, prevent a carry trade unwind, and stop collapse across Asia. None of this started actually on August 1st. Japan turned the dial higher again and again, and every turn failed to hold. It started with jaw warning, officials warning through 2024 and 2025 that they were on high alert, hoping words alone would stop the selling. That didn't work, so Japan turned the dial again. Real rate hikes. 5 of them, taking rates from near zero in March 2024 to 1% by June 2026. See, rate hikes doesn't give immediate effect, it takes time to bend the currency's direction. So, Japan turned the dial once more. It started buying yen outright carefully, funded through reserves and interest income rather than selling treasuries to keep them out of US bond market. And it kept turning the dial 4 separate times, each intervention bigger than the last, and every single one failed within weeks. Now here's the part that should genuinely unsettle you. Each time it looked like it had actually worked, the yen rallied, the headlines moved on, nobody checked back in a month, and each time a few weeks later, the fall quietly resumed. Quietly enough that most people never noticed the wind had already reversed. 4 separate movements where Japan believed it had fixed the problem, 4 separate movements where it hadn't. Only after all the 4 did the US-Japan intervention happen. The one using the euro selling route to avoid a visible wave of treasury sales. One tool still sits in the reserve, the Fed's FEMA facility. Japan holds a huge pile of treasuries. If it needs dollars, it can actually sell them or borrow against them. FEMA is a second option. Hand the bonds over as collateral, get the dollars, repay later, and get the bonds back. Think of it like pawning a jewelry. Instead of selling it outright, it never actually leaves the family. But why does none of these create a permanent change? Intervention actually treats the symptoms, it doesn't touch the disease, in this case the interest rate cap. The BOJ had raised rates 5 times since 2024 from near 0 to 1%, real progress on paper. But the Fed is still at roughly 3.5 to 3.75% as of June 2026, even after 3 rate cuts in late 2025. See, the gap still is there. You can do the math. The gap is still north of 2.5%. As long as the gap stays this wide, investors still have every reason to borrow yen and buy dollars. For real fix, Japan needs to raise rates further or US needs to cut them further. Neither is guaranteed right now. See, I want to be fair for the other side of this because not everyone reads Japan's position as fragile. BCA research points to real reasons for optimism. Japan still runs a current account surplus, it owns a huge amount of assets overseas, and its net debt to GDP ratio is actually falling. Even the analysts who studied this professionally are split on how worried to be. That's my honest read too. By the way, not a certainty, I'm handing you a settled fact. Screenshot this if you want to track it. 3 paths. 1. Slow bleed. Some traders are pricing 200 yen to dollar as a tail risk. Some economists call this latest intervention doomed to fail, projecting a slide back to 170. Early stress signs already exist in the first half of 2026. Bankruptcies among small businesses dependent on imports were rising as the weak yen made everything costlier. 2, which could be the sharp reversal, right? The carry trade unwind, and we already have a playbook from August 2024. A year's 15% gain wiped out in 5 trading days. The Nikkei down 12% in a single session, the shock spreading into Europe. If BOJ moves too fast or another intervention lands too hard, investors could be forced to unwind yen positions all at once. That pulls money out of emerging market stocks, bonds, and currencies across Asia all in one go. 3. Treasury path. If Japan ends up selling treasuries again, US yields could rise, potentially making the dollar stronger again, undoing the entire point of the intervention. But there's a flip side. If yen strengthens towards the 146 level some forecasters expect by year end, investors could rotate money out of US assets and into emerging markets. India could be one of the beneficiaries of that shift. Either way, what happens next depends far less on Japan's next move than on what the Federal Reserve does with rates. So what this actually means for you? Here's the part most coverages skip. What this actually means outside Tokyo and Washington. Rising treasury yields don't stay contained to America. They ripple through global bond pricing, and that touches you directly if you're holding 401k, US equities, or dollar bonds. And if capital does rotate towards emerging markets the way the path 3 suggests, that's the other side of the same coin for someone whose money is mostly sits in India. What's the fix here? You don't need to predict which of the 3 paths wins. Nobody can actually do that, and I'm not going to pretend I can either. What you can actually do is check honestly how split your own exposure already is between dollar assets and rupee assets. That's a single portfolio review, not a strategy overhaul. If you're heavily concentrated in one currency and one of these paths hits fast, you'll find out the hard way at the worst possible moment. Remember, the 2024 version of this wiped out a year's gain in 5 trading days. A split you've actually checked cost you an afternoon. A split you've never checked cost you the ability to react before the move is already over. Here's the thing about the story like this one. You are never going to get a vote on what the Fed does next or what Japan decides this quarter. Nobody watching this does. Tokyo and Washington are going to make these calls with or without you in the room. Most people think currencies move because of economics, but sometimes they move because governments are terrified of what happens if they don't. But you do get a vote on one thing: whether your own money is sitting exposed to just one side of the story or built to take the hit whichever way it actually breaks. That's not a small consolation. In a story this far outside your control, it might be the only lever you actually have. If you hold US linked investments, which of the 3 paths are you watching most closely? The slow bleed, the sharp reversal, or the treasury path? Tell me in the comments. I read every single one of them. And if this helped you make sense of a story that's genuinely hard to follow in the financial press, send it to that friend who keeps asking what's actually going on with the yen. That's it from me. I'm Nikhil. Subscribe to learn how to make your finances less tricky with FinNiki. Thank you for watching, and I'll see you in the next one.